Good day, everybody. Today we are going to get into Chapter 3 in our textbook where we're going to talk about financial statements. So here's a quote or a little story from page 1 of our textbook talking about that as early as 3700 BC, there's recorded that people were doing accounting. So look at that. Accounting is important. Throughout the course of the history of a time, we have had to account for things. And as a CPA, that just makes me smile. And you guys can understand how important that this is and has always been. So what we're going to talk about here at the beginning of Chapter 3, looking at the difference between accrual and cash accounting, looking at common financial statements, looking at the results on those financial statements, talking about our net worth, and looking at what happens to that net worth and when it can really end up leading to bankruptcy. So once again, we even have published books talking about accounting and financial statements going back to the early 1400s. So accrual accounting versus cash accounting. So if you guys have taken Principles of Accounting course in the past, hopefully you understand the difference between those. For you guys that are non-accountants, the difference between cash and accrual accounting. Cash accounting, we account for things when cash changes hands. When we bring in cash, when we spend cash. Whereas accrual accounting looks at when things are earned or when things are used up. They're recognized as income and expenses. In this case, they say when the goods have changed hands. So some action has taken that a transaction has been completed, but it hasn't necessarily been paid for. But you guys as individuals, you all are going to be under cash accounting. When I bring my money in, when I spend my money out. That's what we'll be focusing on. So 3 of the key financial statements, once again, something you would have covered in Principles of Accounting course. We have our income statement, we have our cash flow statement, and we have our balance sheet. So first off, our income statement. And our income statement lists specifically our income and our expenses. So like I was saying before, our income, what did we bring in? Our expenses, what did we spend out? What resources did we use and pay for? Over the course of our week, over the course of our month, over the course of our year, our lifetime, etc. So here would be an example from our textbook looking at an income statement. So throughout Chapter 1, we're looking at the examples for this person named Alice and what her financial results were. So you see for her income statement, her wages are her revenue or her income. So in this case, this income statement, we're looking at it for the entire year. And then we've got her payroll deductions. So that's what's coming out of your paycheck. You're not even seeing that. So the difference between your deductions and your gross income would be your disposable income, what you take home at the end of the day, what shows up on your paycheck or on your pay stub. And then we have all the various expenses. So what are we spending our money on from day to day? So we've got our necessities, shelter, food, clothing, transportation, in these days, a cell phone, internet, and then we have our other things, entertainment. And then if we have debt, what's the interest on that debt? Common debt in this case, vehicle debt, and also student loan debt. So we've got the interest on those items, and then the difference between our revenues or our disposable income and our expenses would be our net income. But we'll get to one very key thing in a little bit that is not being factored in to this income statement. So hopefully at the end of our semester-long project, you guys will be able to do this with the financial information. So we're going to be tracking our data over the course of the next, give or take 6-7 weeks. And then looking at, okay, how does this look for me? What were my revenues for that period? How much did I take in? What were my various expenses? And how much did I spend on them? And you'll be able to look at this and see what is your net income. We can also take a look at our cash flow statement, which just as in the name looks at our flow of cash. And it's broken down into 3 sections: operating, investing, and financing activities. And the big difference between the cash flow statement and the income statement is the income statement's not recognizing our debt payments. So our debt payments are now going to be factored in to the cash flow statement. Only the interest was listed on the on our income statement here that this textbook uses. So here we've got Alice's cash flow statement. Her operating cash flows, that's basically our net income that we just took a look at from our income statement. So all of this is the same. And then the additional items now under financing cash flows would be the paying back of debt. So now here's the principal on that car loan. Here's the principal on that student loan that weren't being factored into that income statement. So now when we factor out the payment of principal that we have to have on that debt, well, on a cash flow basis, Alice isn't necessarily looking as good. She's only $400 ahead. So after all the money that comes in, all the money that comes out, she's a positive $400. Now on the benefit, we can say, hey, that's positive. So that's a good start. She is not spending every dime that she makes. Pretty close, but not everything. And then as we get into a few chapters later, we can talk about budgeting. If there's anything we can do to manage, to limit ourselves in these expense categories so that we can get this net cash flow higher. And we can develop a savings so we can save for a house and don't have to have this rent expense all the time. We can save extra money that we can throw at our car debt, our student loan debt, and get that paid off sooner. Because it'd make a whole bit difference if this debt was gone and she had another $5,600 to play with, to use to put towards a house, to use to put into a retirement plan, etc. And the last financial statement we're going to talk about is the balance sheet. The balance sheet, for you guys that have taken accounting classes, lists the members of the accounting equation. And the accounting equation is assets equals liabilities plus owner's equity. Now, we're not doing a business here. We don't necessarily have owner's equity. It's essentially called net worth in this scenario. But we're just looking specifically at our assets and our debts. So our assets are things that you own. What's your property? What's your stuff? And then our debts would be how much money do we owe. So in this case, our accounting equation, assets equals debts plus net worth. So looking at it just slightly differently from our accounting equation that you know from before. Or another way we move things around, assets minus our debts equals our net worth. If we flip around our equation a little bit. So that's what you want. You want positive. You want to have more stuff than you owe. And if you have more debts than stuff you owe, well, that's going to become a problem. So we want the greater side. Oof. If we're on the negative side, now we're in trouble. Because if the banker calls our debts and they repossess the assets, it's not enough to pay off that debt that we have. And you have too many debts that you can't satisfy, you could end up filing for bankruptcy, which is not something that we want to do. So we got to be on top of things. We got to manage our money. We got to be careful we're not spending money we don't have. And we'll cover this a lot more as we get into the chapters from here, looking specifically at things like credit cards, because people get in a lot of trouble with credit card debt. And you've got thousands of dollars of credit card debt, and that's gone. You know, the stuff, maybe you used it for a vacation, that's, you know, they can't repossess the vacation. So you don't have an asset there, but you got a pile of debt. So here would be looking at an example in my textbook on page 47, looking at Alice's balance sheet. So looking at the assets, what does she have? What does she own? In this case, she's got a car and she's got a little bit in savings. But what does she owe? A whole lot. When you've got the loan on that car, which thankfully is less than the value of the car, so we're making progress on that. We almost got that paid off. And then she can own that scot-free without any car payment. There is no law that says you have to have a car payment. So I would say buy as cheap a car as you can get around with to make whatever your daily driving is. Don't take out too much debt. Don't go getting a brand new car unless you pay on paying it off and then driving it for another 5 to 10 years after you have it paid off. Don't just roll it in and go trade it in and go get another one so you're stuck with a payment month after month after month. And then of course Alice has those student loans. In this case, $53,000, hopefully with your guys' Mayville State education, you end up a lot lower than this. But now that's a big chunk to have to make little dents out of month after month after month. So her net worth in this case is negative. And you know, as you guys are young, you're in college, or when you graduate, you get out of college, this is going to be the case. Because of that student loan debt, you're going to owe a lot more than you have. But as you then get in your careers, start making good money, hopefully we can give you the tools throughout this course to knock out that debt rather quickly and start to accumulate assets, buy your first home, buy a new car, whatever, all the stuff that we get in our lives. So, from this section, remember, we've got our 3 financial statements: the income statement, the cash flow statement, and the balance sheet. The balance sheet is always looking at where were we sitting as of right now. As of a specific date, here's what we own, here's what we owe. And whereas the income statement and balance sheet looks over a period of time, is my income statement for a year, for a month, for a week, what time period I'm looking at. And I would recommend tracking your stuff monthly. So every month, what did you bring in for your job? What were your earnings from any other outside sources that you have? And then what did you spend? And what did you spend in all those categories? And looking at making sure you're doing it on a cash flow basis so you have the entire picture. So not just the interest payment, but the debt payments too. What's everything that's going out? And we want it to be positive. We don't want to be spending more than we make. Then we end up in trouble, end up with using credit cards more than we should, and have issues. So we got all the specifics of those financial statements. Your net worth is the difference between your assets and your debts. And if you come up negative, then we're going to have problems and possibly end up filing for bankruptcy. and we don't want to do any of that. So the next step, we're going to look at each common-sized financial statement, look at how changes in the balance sheet, we can see how they're connected to the income statement or the cash flow statement. We're going to talk about ratio analysis. We're going to look at comparing things and doing financial analysis. Once again, if you're a business major, similar to things that you've done in previous courses. So one way we can take a look at the items in our financial statements would be looking at each item as a percentage, essentially a percentage of another number. In this case, a percentage of our income, or a percentage of our positive total cash flow, or a percentage of our assets if we were looking at it on a balance sheet. You're going to go through an example in your homework where you're going to have a cash flow statement and do it as a percentage of income, or the positive cash flow. So here would be looking at Alice's stuff and what would be all her expenses as a percentage of her wages. And we can see what the larger ones, make up. Rent expense, 22%. Whether we're renting, whether we're paying off a mortgage, this is going to make up a significant chunk of our expenses, no matter what. And we have to have that shelter to live. So, another big one, food is going to represent a larger percentage. In this case, her student loan interest is a big chunk. Taxes and deductions, there's nothing you can do about that. That's always going to be, we have to pay our taxes. And in this case, you see, looking at hers, 21% of her expenses are going to clothing. So maybe this is an area that Alice could look at and go, oh boy, that seems like a lot, that a fifth of all my money is going to clothes. Maybe I can make an adjustment there. When we look at on her cash flow statement and check out the percentages, we're adding in our principal payments on our debt. So now that principal on the student loan is taking up a large chunk. The principal on paying off her car is taking up a large chunk. So that's why we got to get rid of these debt payments and look at it in this perspective and realize how much of our lives are spent paying bad debt. How much of all the work that you do, all the hard work to get the income that you have, goes to paying off debt. And how we need to rid ourselves of that as soon as possible. So here, if we look at our financial statements and how they are connected, we've got where our balance sheet starts, and then the items that are on balance sheet are going to be affected by what we spend out on our income statement and our cash flow statement. So as we pay on our debt, that's going to affect what shows up there on the balance sheet then in the end. And we can see how we knock down some of that principal and what gets to our ending balance of our debt is. We can see what positive cash flow that we had that hopefully we put in our savings that then ends up on that ending balance sheet. If you guys have taken Accounting 201 or Managerial Finance course, we've looked at financial ratios. So financial ratios analyze our financial results. So look at analyzing the items on our income statement, our cash flow statement, our balance sheet, and see how they correlate together. So we have some different ratios that we can use to do that analysis. So see here, looking at return on assets. How well are we using the assets that we have? Looking at debt to assets. Once again, comparing the assets that we have and what debt do we have. Normally that debt would be used to pay for the assets. And once again, we're going to have trouble as that debt number becomes higher. Looking at, do we have enough income to pay off our interest? Looking at free cash flow, do we have extra cash that we can use to pay down our debt once we've covered our basic expenses? So we can see all those different ratios, what we're doing with them, and what they should be. So this is something that as you're getting into writing your paper and you're talking about looking at your finances over the course of the semester, I didn't put specific requirements in there for this stuff, but this is something that you could do. You could do some of this analysis on the results to accentuate that discussion in your paper and how you're doing compared to these standards. So once again, we want to look at a comparison, and we want to look at comparisons over time. So looking at where we've been either year to year, where we've been month to month, and we want to see that we're making progress. So in the results that we want greater than 1, and where things that we want to be bigger, we want to see that trend of those items going up over time. So we want to see that we're making good financial decisions and improving those things. If we don't, we see the opposite. Well, then, if we're, possibly looking at a big purchase, looking at a new car, looking at upgrading anything, looking at spending a lot of money, if our financial performance is not good, we really shouldn't be then, adding to it and doing anything that's going to take out more debt or cost us more money. So look at everything over time. If we do common size financial statements and look at things as a percentage of a common denominator, once again, it can help those numbers, look at them from a different perspective. So not just looking at them in dollars like we did on the income statement, but looking at them in percentages and how they compare as percentages can help, make the point a little clearer to us of what chunk of our money is going for certain items. And then possible changes that we need to make in those areas. When I started dating my wife, the big notice that I had was looking at how much I was now spending on going out to eat. Generally, I didn't go out to eat a lot on my own, just ate at home, and then that number quadrupled, went up like 5 times, and I go, oh boy. Well, we got to look at, cutting this down a little bit. Are we going out to eat too much? And try to change that number. So we can do that same analysis on all our financial statements, on the income statement, on the cash flow statement, on the balance sheet. Changes in the cash flow statement and the income statement are going to be shown on the balance sheet over time, especially those debt payments, especially our savings. Another way we can do comparison is through ratio analysis and looking at those ratios over time and what progress that we've made. And that comparison, like I said, can be done monthly, and at the very least should be done annually, and seeing from year to year in total, how are we doing and what's happening in our financial lives. In the last part of the chapter, we're going to talk about personal finance software. looking at the features of them. They talk a little bit about all this stuff that can be brought into personal finance software and help you in making your financial decisions. So, and this, we have a section in that year-long project, once again. I would like you to use a personal finance software, or at the very least, use the Excel spreadsheet that I put into Moodle to track all this stuff. And with technology these days, the technology's there to make this a lot easier for us. We don't necessarily have to be accountants. You don't necessarily have to have fun going through and accounting for this stuff like I do, if that's not your game. So we got to collect the data, we got to show the results, and then we got to use it to be able to plan for the future. So like I said, software is going to help us make our decisions in the future for education, retirement, paying off debt, entering into a mortgage, looking at and being able to do our budgeting. If you guys already use online banking, take a look at that. It may already do some of this stuff for you. You just got to put a little work into coding some of your basic expenses, what category they're going to, and you should be able to do this analysis without a lot of effort. My bank just got this feature, so it's going to make it a lot quicker than for me having to put all this stuff into a Quicken or a QuickBooks. So that's what I want you to do. I want you guys to try to find a program that's going to be good for you, that works for you, for being able to do this analysis. And I provided some suggestions within the instructions in Moodle. If those work for you, try them out. And all the ones I believe are free, so it's not going to cost you anything to go through and try them, at least over the course of this semester. Always be careful with passwords. Remember, that is sensitive financial information that you don't want others to get a hold of. From what I looked at, they are secure and your data should be protected. But if you're worried about that, we have the Excel option. So that's everything within Chapter 3. So try and get a start on that. Try at the very least, get signed up for one of these programs so that you can get started in this semester-long analysis of your finances. So that's Chapter 3. If you have any questions, please don't hesitate to let me know.